Hey everyone, hope you're doing well. In this video, I want to answer two very important questions. The first is, will the Federal Reserve raise rates once again? And secondly, probably the more important question is, regardless of what the Fed does, when in the future can we expect to see cheaper or lower interest rates? So let's answer those questions. Today's going to be a slightly different video because I have notes here that I want to go over, and I'm going to combine my opinions as well as the opinions of other experts in the field to give you a general consensus of what is most likely going to happen. So let's do just that. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's talk about the interest rate. So right off the bat, the first thing I want to cover is whether or not the Federal Reserve will raise interest rates again. Now, this is coming straight from the Federal Reserve Governor, Michelle Bowman, and she says an increase in interest rates is likely appropriate. Now, I think the general consensus is that interest rates are going to go up again, probably a quarter basis point, which means 0.25%. Really, the main question is, will that happen in the November meeting, or will it happen in the December meeting, or will it happen next year? So it's not so much a question of if rates are going to go up at this point, it's more of a question of when rates are going to go up, and is it going to come in 2023 or early 2024? That seems to be the general consensus, and that also, I believe personally, that is strengthened by the most recent jobs report. Remember, we just had a jobs report, and that jobs report, while there are some funny things that we did talk about, overall on the jobs report, it is a strong report, and that is only going to strengthen the Federal Reserve's understanding of how the market is going, and it's going to give the Federal Reserve ammunition to be able to raise rates higher or hold them higher for longer. Because remember, a strong economy gives the Fed breathing room to raise rates or to keep rates higher. Why? Because remember, when you raise interest rates, usually the economy suffers. So if the economy is holding strong or is being resilient in the face of high interest rates, it gives the Federal Reserve ammunition to keep rates higher. So I think the general consensus is right off the bat, yes, rates should and most likely will go higher. Now, this is always subject to change, but that is just the fact of the matter. So I think what we should spend the bulk of the time in this video is more so talking about when are we going to see a reduction in interest rates? Because remember, interest rates affect everything in our daily lives. They affect car loans. They affect credit card rates. They affect mortgages. And mortgages are probably the biggest one because right now houses are so expensive. So if you want to buy a house, not only is the housing market extremely expensive, but interest rates are also through the roof. Right now we have above 7% interest rates. So let's go over that. When can we expect a reduction? So what I want to do is I kind of want to go over some very important people in this industry and their opinions, okay? And then I'm going to kind of give you my thoughts on the whole matter. The reason why I want to go over these people's opinions is because I want you to understand that nobody has a crystal ball and everyone is just making inferences about the future. And there is a very big difference between assumptions and presumptions, right? Presumptions are basically educated guesses based on data. And I think each and every single one of these people are doing that, but it's still very difficult to come to a general consensus. So let's go off right off the bat. Fannie Mae, which is a huge corporation, or excuse me, huge organization. Fannie Mae says that they don't see mortgages rates dropping, so we're talking mortgage rates, dropping below 6% until 2025. It's probably not what most people wanted to hear, especially if you're in the market for a house. But Fannie Mae doesn't see mortgage rates dropping below 6%, which is 6% is double what they were just a couple years ago. A lot of us are accustomed to 3% and below interest rates. So 6% is double that. And they don't expect to see mortgage rates come below that until 2025. That is a whole year and a half out. So again, this is probably going to foreshadow the direction of this video, which is that we are in a high interest rate environment, and we're going to operate in a high interest rate environment as an economy for quite some time. Okay, now again, I touched on this already, but I want to touch on this one more time. Strong jobs growth gives the Fed reason to raise rates and or hold them higher for longer. I went over why that is the case. Just remember, when you have strong jobs growth, that in a sense is signaling that the economy is resilient in the face of these interest rates. So the Fed is going to be less cautious, or in other words, is going to be more hawkish, less dovish with its policy. Okay, let's go over the next person. Chief economist at the National Association of Realtors. These are people who just do basically just do real estate, says 3% mortgages, which is what we are accustomed to, is unlikely anytime soon. And that matches up with Fannie Mae's prediction of 6% and above until until 2025. So people who are in the real estate and experts who are in the real estate market say that we are probably the times of 3% mortgages are probably behind us and probably not going to be in our future anytime soon. And when we say in our future anytime soon, economically we're talking 1, 2, 3 years out. Okay, now let's actually talk about interest rate, about the federal funds rate. Okay, that is the Federal Reserve has direct control over that rate, and right now that rate is sitting quite high. Okay, so let's talk about that. So Morningstar, which is a large financial corporation, news corporation, senior U.S. economist says that he believes that interest rates, that the Fed will not start cutting interest rates, which means lowering their federal funds rate, until February of 2024. And what I want to do is over the next 1, 2, 3, 4, the next 4 people, I want to kind of show you how it's quite interesting how you can have multiple experts and their time frame is completely different. Okay, so Morningstar senior economist says February, that we will start seeing a reduction in the federal funds rate. Okay, February 2024. Okay, then in a Reuters poll, 97 economists, took this poll, and the consensus for them was so that means the overarching opinion of those economists was that we will see a reduction or the beginning of a reduction of rates between April and June. So first person we have says February. The next group of people say between April and June. Okay, and then we're going to move forward. We have Goldman Sachs chief U.S. economist David Miracle, and I hope I'm not butchering his name, says second quarter of 2024. Okay, so we have February, we have April to June, which is like first quarter going into second quarter. Then we have Goldman Sachs saying second quarter. Okay, and then I want to do one more, which is Jeff Morton, a portfolio manager at DWS. He says late 2024. Now remember, we're talking purely about the federal funds rate and cutting of the federal funds rate, which means the Fed moving into a dovish policy. So you have multiple experts. Some people say at the beginning of the year, some people say middle of the year, and some people say late 2024. Nobody says this year because it's not going to happen. But it's interesting how we cannot seem to get a general consensus. I would say out of all of these, the most quote-unquote reliable is probably the poll, because the Reuters poll took into account 97 economists, and the general consensus for them was between April and June, which is about second quarter of 2024. So a couple of things that we have to touch on when we're talking about interest rates. Okay, first and foremost, I want to give you my opinion, and then I want to kind of explain how, regardless of when it starts cutting, that doesn't necessarily signify that we're going to have low interest rate environment. So first and foremost, my opinion, when do I think that the Fed is going to start cutting rates? Here's the thing. I just want you to know I don't have a magic 8-ball, and I do not believe I'm smarter than any of these people, and I am not smarter than you. Okay, so take everything that I say with a grain of salt and understand that I'm doing my best to give you my perspective based on evidence, but no one has a magic 8-ball. Okay, so in my opinion, I think if I had to just guess, I would personally say it's going to be mid to maybe late 2024. The only reason I don't say late 2024 is because it is an election year. So the Federal Reserve is supposed to be a non-political organization. They do not want to take sides politically. So if this was not an election year, I would have said late 2024. But because it is an election year, I could see it going one of two ways. I could see them either cutting in the first half of 2024 because they want to stay away from the election cycle. They do not want to raise or lower or do anything that would signify, hey, I'm supporting one party or the other. They don't want that. They don't want the political spotlight. Okay, so I could either, if inflation over the next few reports is really, really good, I could see them start cutting earlier. If inflation is not good or bad, I could see it being pushed to late 2024 before the election cycle or after the election cycle if inflation is still not coming down. So it really, I think that the fact that 2024 is an election year um, kind of makes the Fed, I guess, going to have to be more cautious about when to cut rates because they don't want to signal any support for either side of the political aisle. They don't want to do that in most instances. So that's my opinion. I would say the Reuters poll, I tend to be one who follows data as much as possible. I love statistics and I love data. And when you have a group of 97 people and the consensus is between April and June, I feel like that is the most appropriate response. So here's the thing, and this is, I guess, what I really want to touch on. Regardless of when we start cutting interest rates, whether it's in February or whether it's late 2024, remember, the Fed is not going to go from 5.5 or 6%, whatever they end up at, federal funds rate. They're not going to go from that to zero, right? Or to 1% or to 2%. They're going to take it slow and they're going to cut it slowly. So no matter when they start cutting rates, we're not going to be in a low interest rate environment for some time if we ever get there. Here's the other thing. Because the economy and because inflation seems to be so sticky and because the economy does seem to be resilient to interest rates hikes, I can also, I would, if I had to take a stab in the dark, I would also say that I'm uncertain if we will ever get down to a federal funds rate of near zero anytime in the near future. I think that the Fed is going to hold rates at 1 or 2% or higher for one of two reasons. One, to save juice when a recession does come around, okay? Because if they are at 0% interest rates and a recession comes, they cannot lower rates. So I don't think that we're going to get this, this near zero interest rate environment again, unfortunately, not for some time. But I do believe that we will see lower interest rates. The federal funds rate, maybe 1%, 2%, or 3%, hopefully by the end of 2025 at the very latest. But remember, these things take time and they move very slowly. And that is because basically what the Fed does is the Fed does something and then it waits for data and then does something again and then it waits for data because the Fed is data driven and their decisions are data driven. Okay, they don't just whimsically pull something out of the hat. So even though sometimes it feels like that, they try to be data driven. And I'm not a cheerleader for the Fed. I'm just saying what they try to do. Okay, so it takes time because they have to do something, raise or lower rates, and then they have to wait for data to come in, and then they raise and lower rates, and then they wait for data. So it takes time, and it's going to take time. So I hope this video was informative. I just wanted to give you an update on my thoughts as well as the thoughts of some experts in the field on what exactly is going on when interest rates might be cut sometime in the future, and more importantly, I guess not more importantly, but just as importantly, is the Fed going to raise interest rates? And the consensus right now is that most likely they will, at least 25 basis points, right, which is 0.25%. Which will bring the federal funds rate quite high, and it already is quite high, but it is not historically high. So what I mean by that is in recent past, over the last 30 years or so, it is high, but historically, interest rates, the federal funds rate, and interest rates have been a lot higher before, but it is still high, especially when we are accustomed to such low rates. And here's the other thing. And when the economy is accustomed to growing on such low rates. Because if the economy was accustomed to growing at higher rates, there'd be less risk of a recession. But because the economy, the current economy that we have is built on the back of low interest rates, the current interest rates do feel very high. But anyways, I hope this video was informative. I don't want to make it too long. I just want to give you an update on the interest rate environment going forward, ending 2023 and moving into 2024. We're in a high interest rate environment. It's going to be like that. So take advantage of high yield savings accounts while you can, and take advantage of other assets that historically did not pay this much returns. Watch yourself in the bond market. I think there's some possibility for returns in the bond market. But remember, when interest rates go up, bonds come down. So it is a timing game sometimes if you're going to sell before maturity. So I don't want to talk about bonds too much, but basically just look at other investments that historically maybe weren't giving such high yields. Because right now, because of the fact that we're in a high interest rate environment, there are some assets that are giving high yields currently. So hope this was helpful. As always, my name is Derek, and I got my degree in finance, so you don't have to. I love you guys. I love this stuff. I love economics, and I love being able to have a conversation with you guys. If you have something to add, please feel free to leave it in the comments. As I always say here, I have a degree in finance, but that does not make me God. There are people stupider than me, and there are people way smarter than me, and there are people more experienced than me, and there are people less experienced than me, okay? You might fall anywhere on that spectrum, and I can always learn from you, just like you can learn from me. I do not have a chip on my shoulder, and I never want to be one of those people who has a chip on their shoulder. I want to learn from you just as much as you can learn from me, and I want to learn from other experts. So this channel is an open conversation. This channel is meant to be a place of growth, so we can all learn, and so you can, of course, improve your personal finance. So one more thing. If you like personal finance and you like economics, you're in the right place. Please consider subscribing if you haven't already. This is a relatively new YouTube channel, and I'm passionate about it, so it helps the channel tremendously. And don't forget to turn on the bell notification so you don't miss the next video. They're usually on Tuesdays, but lately I've been doing a video on Wednesday, Thursday, or Friday because there's so much to talk about economically right now. But usually main content is on Tuesdays. Other than that, I hope you guys are doing great. I hope you have a fantastic rest of your week, and I will see you in the next video. Take care.